I'd like to welcome Jonathan Chevreau to the show. Jonathan is currently the investing editor at large with Money Sense magazine, and many of you may recognize him from the personal finance column that he wrote for the Financial Post newspaper for 19 years. In addition, he's an author and founder of the Financial Independence Hub, which describes itself as North America's gateway to financial independence. I'd like to again thank Jonathan for joining the show, and welcome to the show, John.
Thanks for having me, Alan. I'm looking forward to it.
That's great. That's great. So, John, I thought I'd start by asking you the question. I know you interview a lot of people, you talk to a lot of people, you have definitely your finger on the pulse of what's going on out there. What do you think is making these markets so jittery? Why do you think we're seeing such volatility in the markets? Is it interest rates? Is it inflation? Is it something else? What do you think is really causing these markets to gyrate as much as they have been over the first 6 months?
Well, I think you yourself tackled this topic of inflation, interest rates in one of your recent Money Sense columns, and a lot of us have been as well. You just look at the classic balance fund, the asset allocation ETFs, the Vanguard's VBAL or iShares XBAL or BMO ZBAL, all the same thing, 60-40. It's the first time in 40 years that both sides of the barbell have been down in 2022. So usually if stocks go down, you feel compensated in the balance fund because the bonds are up. Of course, this year, because of the interest rates going up, bonds are going down. So it's pretty unprecedented. And no wonder investors are nervous. It almost seems like there's no asset class where you can safely hide. Although I would say that I'm about on my hub to reprint a thing on Vanguard recently put out a post saying that rumors of the death of the balanced ETF or balanced fund classic are exaggerated, and they expect it to rise Phoenix-like very soon. Let's just hope so.
Yeah, and we talk about nowhere to hide, and obviously I think a lot of that has to do with rising interest rates. And kind of let's move on to that topic. Yeah, interest rates have been on the rise now for the first six and a half months of this year. We've gone from a prime rate of just under 2.5% to a prime rate now of 4.7%. Interest rates, have been moving quite rapidly. The Bank of Canada, even the Fed in the United States has been raising rates. Do you think that they need to continue to raise rates as fast as they have been to get this inflationary pressure under control? Do you think this is the best path for them to go forward?
Well, if you believe in the 80s and Volcker in the States, at one point in the 80s, I think interest rates were close to 20%. I even remember a time when my mortgage was 12%. And at that time, that was quite a shock to the system. You remember the Arab oil embargo and all that sort of thing. So I think they do need to raise. I fully expect them to raise another 75. Perhaps the Fed today will be raising 50 or 75 basis points. The Bank of Canada last week surprised people with 75 basis points, where people expected 50. So I'd expect at least one or two more rounds for the rest of this year. After that, maybe things simmer down. Obviously, if the market starts to really get bad, the last I checked this morning, tech stocks in particular were up on Microsoft and Google's relative optimistic performance. So that's good. But certainly people are on tender hooks. But the thing about interest rates being rising, it's not all bad news. It's bad news if you're a young person trying to get into an overpriced Toronto or Vancouver real estate market. The price of the houses is really high, and all of a sudden it's going to cost a lot more to you're no longer having practically 0% financing. But on the other hand, for people like myself who are semi-retired and retired, for years it's been frustrating because going back to the classic balance fund, you wanted to get some decent returns, not just on the stock side, but on the bond side. And when you were getting 1% on a GIC or something, that was pretty frustrating. What I would call financial repression on the part of the central banks. Now, since last week, if you go to places like EQ Bank or Oaken Financial, you can get a 5% on a 5-year GIC. So I think that's actually good news for somebody who's wanting to take less risk in the stock market. You have to have, with this inflation, 50 or 60% in stocks, I think. But if you really value having a bit of a buffer, then it's time to, I think, personally, I do still invest in GICs as well as bond ETFs. bond ETFs have been hammered, as you know, particularly if you're in the longer term ones as opposed to short term bond ETFs. But whereas GICs till recently would have been prudent to be in 1 or 2 year terms, hoping that you can cash in when they do raise rates. Well, now they have, so it makes sense. I think Rob Carrick at the Globe just last week wrote a piece saying it was time to build 5-year GICs. I think Gordon Pape has written the same thing. So it's not all bad news. It depends where you are in the financial life cycle.
Yeah, no, for sure. And I was fortunate enough to be on with Gordon Pape Zoomer show with Libby Znaimer, I guess about a week and a half ago. We actually spoke about that, where GICs are now a lot higher. Obviously, with inflation running at 8%, owning a 4 or 5% GIC, unfortunately, doesn't really get you any further. But at least now your retirees and those that need a fixed income could actually get a higher rate. I just worry, I guess, from my perspective about raising interest rates. I guess my commentary for the last little while, and it's funny, Elizabeth Warren, senator in the U.S., actually echoed the same statements this morning. Not often I say the same things as Elizabeth Warren, but she was saying how she doesn't believe raising rates is going to fix the inflation problem. And I agree with that. Eventually it will, because it will slow down everything to the point where you'll have a very large slowdown in the economy, perhaps even taking us into a recession, which many people are fearing, and obviously the stock market as well. But when you look at the main problem, higher oil, labor issues, higher commodity prices on some goods, these are things that, unfortunately, when you raise interest rates, in my opinion, they just don't fix the problem, right? How can we get China to open up, from their zero COVID policy sooner by raising interest rates? Or, unfortunately, the whole situation, Russia, Ukraine, with the oil and not enough oil in the world right now. These are issues that, in my opinion, have caused the inflation rate to perhaps, double, from where it probably would have been had we not seen a war in Ukraine. So it's unfortunate, in my opinion, that we're seeing these inflationary pressures as we are. A lot of them can't be held, or I guess can't be fixed by the Fed raising rates. But that's the only tool they have, like you said, in their bag, and they will use it. They will slow down the economy and eventually slow down inflation. And so I guess the next question I go to is, with a slowdown in the economy and seeing some of the reports we have seen recently, some of the big tech stocks like Microsoft, Google reporting what I would call mixed results, not too bad or not as bad as anticipated, but not great either, lends itself to some really good bargains out there. Do you think that the savvy investor could take advantage of some of these bargains that we're seeing out there? Some of these stocks are down 25, 30 plus %. I think there's a lot of opportunity out there for someone looking for growth in their portfolio.
Well, if you look at the Cathie Wood sort of innovation stocks, a lot of them, I know because I own some of them, are down 70%. If you're talking about any of the pandemic plays, Shopify in Canada, it's just been hammered. We all know. So going back to, I think we did have markets topped out last November, and I think it was in part it was because interest rates were left lower for longer, too low, artificially low, I would say, and I think that we had that basically a bubble, certainly in the innovation stocks. And cryptocurrency is another good example. That's something that's gotten slammed as well. So ironically, crypto was billed as sort of an inflation hedge, well, as was gold. Neither of them have done very particularly well. Yeah, since inflation crypto has been hammered in half. In fact, you talk about Zoomer. I wrote a piece for Zoomer magazine myself on this very thing on crypto. So personally, I again, if you're an older investor, I think you want to go back to that balanced portfolio. I mean, now is not a time to sell the balanced funds or even bond ETFs. That would be selling low. You want to buy low, and I think right now balanced funds is an opportunity. So I would be, quality dividend U.S. paying stocks, or the Canadian oligarch stocks like the banks, the telcos. We saw the power of the telcos when Rogers was down for a day or two. You realize how dependent we all are on the internet. Yes, sure. And then you got your pipelines and utilities. There's a lot of good oligarch must-have stocks right here in Canada, which probably should be held in your TFSA or non-registered, keeping your RSP for U.S. dividend payers. So I think it's a good time to buy quality when it's on sale. I certainly wouldn't be jumping in to buy the Cathie Wood stocks right now. Maybe very small flyer, averaging in very slowly. Or me personally, I try a little bit of ARK itself, ARKK. Why buy the underlying when she's pretty good job at bottom fishing?
Yeah, no, for sure. And we know that 90% of a person's return definitely come from asset mix, not necessarily which stocks in particular, but the asset mix itself. And I guess lastly, before we let you go, I know you published a survey on your financial or Findependence Hub. This was a survey, Scotiabank survey, talking a bit about how individuals are definitely a lot more concerned about what's going on and how it's hitting certain segments of the population harder than others. In terms of they're concerned about the inflation, how it's affecting them. What was your main takeaway from the survey? What did you see, and what stood out to you as most important with that survey?
Well, I think the survey confirms what most of us know. If you walk into a grocery store, you'll know the price of everything. I mean, we like to have fish, salmon, for example. Well, that's way up. Or more mundane items like just vegetables and cauliflower, you name it. Or the other phenomenon is shrinkflation, where you think you paid, the price hasn't really gone up, but they just took my cereal box down in size by 20% in quantity. So I think these are visceral. The gross. I mean, ironically, I believe Loblaws has done very well as a stock in Canada during this whole phenomenon in 2022. So it goes back to how do you protect yourself against what appears to be just steadily increasing costs. So you pretty well must have stocks. When we went to fixed income, I think I would like to mention TIPS, in the U.S. Treasury Inflation Protected Securities or real return bonds in Canada. They were kind of overpricey before. You had to pay a sort of premium to have inflation protection. But now I think that protection might be there. You can't be your cake and eat it too. You talked about the problem with GICs, even at 5%, that they're not really matching inflation. True. But if you can get an inflation-linked bond or an RBB or an ETF that owns them, like this Vanguard VKIP, for example, in the state, then you can have sort of the best of both worlds. So personally, I think the balanced fund is going to be, as Vanguard says, sort of on resurgence. If you buy the funds when they're down, whether it's because the stocks are down or the bonds funds, historically, things like VBAL and XBAL are up. I think they were up 10% in 2021 before they started to come down again. There it is, your classic buy low, sell high opportunity.
For sure. And now that interest rates have risen, obviously the balanced fund becomes even more important. And I think it can finally give that balance, as the name implies, right? Not, balanced funds, not just a whole bunch of stocks and a few bonds. Now you can start to see more bonds in these portfolios. So thank you, John, for being on the show. I want to thank you, and thank you for your knowledge and your expertise. And I look forward to seeing you again down the road.
Just give me a call. Thanks a lot, Alan.
All right. Take care.